Committee. Welcome to this special extraordinary meeting of the Audit and Corporate Governance. Adam, any apologies?
Yeah, apologies from Councillor Jennings, with Councillor Bowden substituting.
Chair, can I just raise a question?
To make the announcement that you're recording.
Okay, and also just ask a question. Is it right that a member of Cabinet in 1819 is sat on this Audit and Corporate Governance Committee reviewing the statutory accounts of 1819? My understanding is that should not happen.
Are you referring to a specific piece of legislation or guidance?
That's something I've read, Matt. I'm obviously not as up-to-date as you are, but I'm raising a query with you as monitoring officer.
I think what you have is a situation where these accounts are 5 or 6 years old, so I think you are obviously not dealing with somebody who's on the Cabinet at the moment, so it's a matter of individual choice for the council concerned, I think. But obviously, if the chair's got any concerns, then fine, but as far as I'm concerned, I'm not overly worried about it. It's a matter that's presented to the whole committee for decision today, so
Okay, can I just formally raise my concern that substitution? Thank you.
Now I can remind committee that Councillor Critchley is recording this. 2018-19 audit findings report, report to the external auditor.
Thank you, Chair. So I'll take you through the headlines and then I will give you a quick stop tour of some of the kind of key findings in the audit. Obviously this has been quite a long and protracted audit, primarily because of the delays on 17-18 audit, which we've discussed in detail in the past. But there were some kind of unique issues as well relating to the 18-19 accounts that we've had to deal with, and I will come to those in a second. The audit is more or less concluded now. There are a few bits that we need to just do and finalise before we sign off. Obviously we need to get the signed accounts and signed representation letter, which are here for approval today. And once we've got that, we should be able to then finalise and sign off the opinion in the next few weeks. In terms of the overall opinion, it will be a modified opinion. These are quite rare in the local government sector, but we are proposing to put a limitation of scope onto the opinion, and that relates to a very specific matter relating to the post-balance sheet events disclosure notes, which are in the accounts. And specifically it relates to these solar farm loans that have been made post-balance sheet. One of the questions that we've asked, as well as recognising the fact that the loans have been made, we did ask the question about whether management had assessed for impairment on those loans since they were made, and management have not been able to provide us with that assessment or an adequate assessment that's in line with the accounting requirements. So it has been agreed that on the basis that management are not able to provide that assessment to us, we will put a limitation of scope to basically say that we cannot get enough evidence to say whether that post-balance sheet event disclosure note is complete or not, and therefore whether the solar farm loans are materially impaired or not. So that's the kind of key headline on the opinion. There are a number of audit adjustments that have been made to the accounts. They total 87 million, and I'll run through some of those adjustments shortly. There are also some unadjusted errors which amount to 1.3 million. We are content that these errors don't need to be adjusted by management on the basis that in total they're not material to the financial position of the council. And as I say, I'll come back to some of those issues in a second. We have also raised a couple of recommendations, and again I'll come back to those shortly. So that's kind of the key headlines of the accounts. In terms of our value for money work, we have completed our work on value for money. We are proposing to issue an adverse value for money conclusion for 18-19. This largely relates to the same matters that were previously reported in the 17-18 audit, which we obviously reported on a year or so ago. Obviously these weaknesses still existed at the point in so therefore are reflected in this conclusion as well. As we do say in the report, we do acknowledge the fact that subsequently management have taken action post-1819 to address some of these issues, particularly on the minimum revenue provision policy. So we do want to recognise that whilst this is an adverse conclusion, some improvements have been made since 1819 to address these issues. I also just need to mention as well the fact that we received an objection from a local elector back in 2019. Whilst some of the matters raised by the local elector weren't eligible, there were some matters that they brought to my attention that I did feel had some substance to them and therefore needed follow-up. They related to the investment in Redwood Financial Partners Limited, an issue around the opening balances and the fact that the 17-18 accounts hadn't been signed off at the time, and also matters relating to potential transactions between Redwood Bank Limited and Redwood Financial Partners Limited and a couple of companies that are connected through joint ownership. The local elector unfortunately did pass away, and we took advice on this, and unfortunately their legal rights to object to the accounts actually expire on their passing. So unfortunately we've not been able to treat this as a formal objection anymore. However, we felt it appropriate to continue to investigate the matters, which we've done, and we've completed our work on that. We're not proposing to uphold any of the matters apart from the one around the valuation in the investment in the bank, which we have concluded was material overstated in the draft accounts, and management have adjusted the valuation down and impaired the value in the draft accounts, which again I'll come back to that matter later. But apart from that matter, we haven't upheld any of the parts of the matters raised by the local elector. I will say at this point just a word of acknowledgement to the finance team, because obviously whilst this has been a very long and protracted audit for us, it's also been a very long and protracted audit for the finance team, so I do want to place some thanks. My thanks to the cooperation of the finance team in dealing with these issues. I appreciate it has taken a long time to resolve some of them, but we have finally got there, so I do want to place some record of my thanks to the finance team. So just to kind of, I will just cherry pick a little aspects of the report now rather than go through every single page. On page 12 of the report, we set out our findings around the valuation of land and buildings. There have been some material adjustments to valuations that are in the accounts, and they totaled 12 million in total. And they're reflected in Appendix C, which summarises the adjusted misstatements. What I would say to members is, whilst... Sorry.
Page 12 of what, Chair?
12.
Page 12? It's
Page 12.
It's page 14 of your pack.
Oh, sorry.
12.
Sorry, I've not looked at pack numbers on my apologies. Two pages in front of me. Okay. Sorry, yeah, page 14 of the pack, page 12 of the report. So this is to do with valuation of land buildings. The work that we did recognised that some of the assets in the draft account had not been formally revalued in year, and the subsequent work that was then done by the valuation team then resulted in, say, £12 million worth of adjustments to that valuation. What I would say, I suppose just to put this in context, valuation of land buildings, it is a highly complex estimate. There's lots of source data and lots of assumptions that are made by the respective experts that the council uses. These adjustments do not in any way actually impact upon the usable reserves. They only impact on non-usable reserves. Therefore, it doesn't affect general fund, and therefore kind of what you then need to raise in terms of council tax. So it doesn't have any impact in that respect. So whilst it is a large material adjustment, it's not necessarily one that I would ask members to be too worried about, in the sense that they are quite common adjustments around valuations. Likewise, on the next page, we talk about our work on valuation of pension fund liability, and again, we have identified some material adjustments to the pension fund liability that was in the accounts. This was partly due to the fact that we requested a revised actuarial assessment on the fact that there was missing unfunded teachers' pension pensions in there. There was also a need to reflect the impact of the McLeod judgment as well. So they've resulted in a £15 million increase in pension liability that's in the draft accounts as well. So again, like valuation of land buildings, this only impacts on unusable reserves. It doesn't impact on usable reserves. So I again just want to be clear that this is a very complex estimate. We do often see material adjustments to these across many local authorities, and so it doesn't impact upon usable reserves. On page 14, we then talk about the work we've done on the regular bank valuation. Initially, the investment...
Sorry, number 16.
Sorry, 16. I need to remember that it was 2 pages. Right, okay. So the regular bank valuation was recorded in the draft accounts of 30.4 million. We requested the authority to do a valuation of that check for potential impairment upon that valuation. That work was done by EY. We've reviewed that and had our experts look at it as well. We're content with the work that EY have done. That concluded that the regular bank investment was only worth 4.3 million, and management have processed the impairment of 26.1 million through the accounts. So that was the findings on the regular bank. On the next page, which is page 15 of the report, page 17 of the pack, we then talk about our work on investment properties in terms of the valuation of them. We have identified an issue there in terms of capitalisation of legal fees on the purchases of those properties. That led to a £4.7 million overstatement in the valuation of those properties, and management again have adjusted for that issue in the final accounts as well. On the next page, page 16 of the report, 18 of the pack, we talk about our work on events after year end. Clearly, this has been a very prolonged period after the balance sheet date, and therefore we've had to do quite a bit of work in this area. So we set out the various findings there. Obviously, talk about Redwood Bank, talk about Together Energy, and obviously I appreciate you will be aware of all the facts around this. But our work essentially concludes that these issues have been properly disclosed in the Council's disclosure notes. On page 17 of the report, 19 of the pack, we then talk about the issue I talked about before in the solar farm loans, and the fact that we've not been able to get enough evidence around whether these loans are materially impaired or not, and therefore placing that limitation scope on the opinion. That's where we got to on that issue. I then will take to page 19 of the report, page 21 of the pack, which sets out our findings on the impact of IFRS 9. IFRS 9 was a new standard that came into force for the first time in 1819. This impacts the Council's accounts more significantly than most other local authorities, and this is predominantly due to the fact that you've got lots of financial instruments that most local authorities don't have, such as loans to housing associations, etc. Obviously the investment, and obviously in post-balance sheet events there are more, including solar farm loans. There was quite a bit of work that we did to challenge management in terms of the accuracy of the assessment that had been done as part of the draft accounts, and eventually management did do an assessment that we were happy with in terms of the classification of the various financial instruments that the Council held. We then subsequently challenged the authority on its assessment of expected credit losses, or particularly on the housing association loans. We received those assessments in February. We've reviewed them with the use of our expert, and we're happy with the position that the Council has got in this account. We have made a recommendation for the Council that going forward that it needs to invest a lot of time as part of its account preparation in dealing with the IFRS 9 issues, including updating the expected credit loss assessment, and also a lot of the new financial instruments that have been entered into post-balance sheet events period. They will need to be assessed for classification as well as part of future accounts as well. I will skip you on page 30 of the report, page 32 of PAC starts our VFM reporting. We just set out our conclusion, which is, as I said before, is an adverse conclusion. And that's predominantly due to issues that existed in 1890 around council's MRP policy, arrangements to ensure compliance with the Prudential Code, monitoring and reporting of commercial investments and decision-making process around regular bank investments. In the back end of the report, we have provided a follow-up review of the recommendations that we raised in 1718 to give members our latest view on what management have done to address those recommendations. And you can find that follow-up on page 42 of the report, page 44 of the pack. I'm not proposing to go through that, but more than happy to take any questions and then may have later. On page 47 of the report, 49 of the pack, we have set out 2 new recommendations that we've raised this year. One of those relates to assets that sit on the fixed asset register and in the fixed assets caption in the accounts, which are effectively net nil book value assets. So essentially this is where they are fully, you have an asset that's still in your books but it's fully depreciated, therefore actually has no value on the balance sheet. There was quite a high material value of these in the fixed asset register, so we've asked management to process adjustment to strip out some of these assets which don't exist anymore because they effectively overstate your gross cost of cumulative depreciation in the note. But we've also asked management to do an annual review to make sure that these assets are de-recognised as soon as they are disposed of. And then the second recommendation is the one that I mentioned before around the need to, as part of the annual accounts process, prepare and update the expected credit loss assessments in line with IFRS 9 for each loan that it has with either housing associations or other commercial entities. Page 48 of the report, 50 of the pack, then starts to set out the audit adjustments. So you can see the various ones relating to PPE and the regular bank. There was also an issue at the bottom of page 50 of the pack around internal recharges that needed to be stripped out as well. And as I say, in total, those adjustments total 85 million in total. The vast majority of those relating to the regular bank impairment, PPE valuation, and also the pension liability changes. We set out on page 52 of the report, 54 of the pack, various disclosure amendments that we've identified, and most of these have been adjusted by management. There are a couple which are to be confirmed once we've got the final set of accounts from management. On page 57 of the report, 59 of the pack, we set out the unadjusted misstatements that we've identified. There were several of these, but as I said, they do total 1.3 million in total, and therefore in totality not material to the accounts, and therefore we are comfortable that management haven't adjusted these. I said I don't propose to go through any of those in detail, but more than happy to take any questions that members may have. And then finally, we do need to report our fees to the audit committee, and they're set out on page 60 of the report, 62 of the pack. And as you can see, there is a sizable increase from proposed to final fee, and that's obviously due to the fact that we've had to do a lot of additional work as part of this audit to finalise it. So I will pause there. I appreciate I've gone through quite a lot of detail there. More than happy to take any questions that members may have on the report.
Thank you, Andrew. It's a very comprehensive report to me. Before I come to can I just ask a quick question on the pension liability changes you referred to? Are they sort of common amongst other local authorities, or is that specific to what was going on in Warrington?
No, as I said, with both PP valuation and pension valuation changes, it isn't unusual to see audit adjustments as part of the audit. They are very complex estimates. There's a lot of expert involvement required. There's often a lot of professional judgment involved. So it's not uncommon to spot issues in this area. So most local authorities usually have some issues in this area that appear in an audit report, so I would describe them as common. And as I said to members before, they don't impact upon your unusable reserves, which it kind of makes them less of a concern. But it is important to get these right from a financial report point of view.
Okay, thank you. Members, Steve Parish.
Thank you. Andrew, I'm sure you're following the accountancy rules in all this respect, but I have used the phrase previously just for the boys about some of these regulations. So can I just check what you're saying with some of the stuff? The limitation is wholly concerned with stuff that was nothing to do with the council accounts in 2019. It's all been stuff subsequently that has to be retrospectively applied. And the on the Redwood Bank issue, we understood that that had already been decided that the investment was lawful, but we thought that dealt with the formal objection, and you said that the formal objection ceased to be a formal objection when the objector died, but you still carried on anyway investigating. And also the McLeod judgment, that also was subsequent to the 2019 accounts. So that was retrospectively applied as well.
So just taking them each in turn, remind me if I did forget any of them. So the issue about the post-balance sheet events, the solar farms, we said that is a requirement that at the point of sign you have to disclose events up to the point of signing the accounts. So you have to. You either have to there's two types of adjusting events potentially. There's an adjusting event which basically is an issue that's come to light after the balance sheet date, but is indicative of the conditions that existed in 1819. We're not talking about anything like that here. But you do also potentially have to have what's called non-adjusting events, which is a disclosure of any material issues that have occurred after the balance sheet date. And obviously the solar farms being lent, one is a material issue that has been disclosed in the accounts, but two, you would then also need to disclose if there's been a material impairment. Now, we're not saying that there has been a material impairment on those loans, what we are saying is we don't know the answer to that question because we've not had the assessment from management to reach a conclusion on that, and that's why we've had to issue a limitation scope on that particular issue. The issue in terms of the elector, so just to be clear, obviously there was the 1718 objection, that's a completely separate objection, that was obviously concluded a couple of years ago. This is a separate objection that was raised in the 1819 accounts by a different local elector. So we obviously had to treat that as a formal objection at the time. The local elector, I think, died last year. So obviously we'd already more or less concluded most of that work before he actually passed. There were some issues obviously around accounting issues around the Redwood Bank valuation, which we were still trying to close down as part of the audit, which is why we hadn't written to the objector at the time. Unfortunately, because we had the advice to say that his rights passed at or expired at the point of his passing, we couldn't therefore treat it as a formal objection, but we did feel it was completely appropriate to continue our work in the areas, partly because we were looking at the menu as part of the accounts audit, so I don't think it would have made a difference in terms of the work that we did. And as I say, ultimately we did conclude that there was a material impairment on that, the bank's investment, on the council's investment in the bank. So I think absolutely right to continue with that work. Sorry, there was one other point which I've now forgotten.
Chair, may I come back to the third point? I'm just trying to be clear that you will not necessarily have looked at the Redwood Bank thing, but for the formal objection, at least that was when it was first made. But I think, given the circumstances, I don't want to pursue that anyway. But I mean, I think the point I'm making is that it's no wonder there are nearly 1,000 local authority accounts outstanding because of the accountancy rules moving the goalposts subsequently to those accounts. And we're glad we're not paying you for telling us how often the rules have changed, but we are paying you for the effect of those changes in the rules being applied retrospectively. And the third one was the McLeod judgment, which seems like another judgment after 2019.
Well, just in terms of the McLeod one, that did actually crop up in 1819, so I appreciate the issue did come live, I think, at the point of preparing the draft accounts. But that was an issue in 2019. It's not something that's kind of come up more recently in that sense. But in terms of the accounting rules haven't changed. The accounting rules, so the financial reporting requirements that we've asked the council to apply here existed in 1819. It is the SIPF code of 2018-19 that we're assessing the council against here. So all of these things, all of these issues here relate to things that applied at the point the draft accounts were prepared.
So Chair, just thinking as well of the valuation of assets of highways and things like that, which was another one that's come up recently. It just seems to be that we are probably 4 years on from when your predecessor said we were only a few weeks away approving the accounts, and here we are just getting close to doing it finally now. So it does seem. I'll just make the point again. It's no wonder Warrington's not the only council that's behind with its accounts.
Any other questions from the committee? Ken?
Thank you, Chair. I have a number of questions to the external auditor. Don't know who. Someone's still on? How's that now? Yeah, I have a number of questions for the external auditor. Probably addressed most or some of them. I also have a number of questions for officers. I think it's page 5. On page 5 of the document, as the external auditor has referred to, there's 85 million of adjustments. And I just make the point again that it would be really useful next time to have a training session that takes the new members of this committee through what is the comprehensive income and expenditure statement and what is the general fund, because certainly that's a nuance of council accounting that is sometimes lost. That 85 million adjustment, I presume that increased the loss on the CIS, as I would understand it.
Yeah, so if you, if I can try and find the page, apologies. So if I can say it's page 51 of the report, or 53, we show in 3 columns the impact on the comprehensive income and expenditure statement and the statement of financial position. So you can see in terms of the total impact on page 51 of the report, 53 of the pack. So there was an £85 million impact on the CIS. I say a lot of that related to the pension and the PPE, so they will get adjusted out, not impact on useful reserves.
Yeah, so they don't impact reserves, but in terms of... Thank you. So they don't impact reserves, but they do impact as I would see it, the profit and loss, but the CIS in the year.
Yes.
And it had the impact of increasing the loss that the council made by 85 million, or the lack of revenue to cover the cost of the council by 85 million. Yeah, thank you. Yeah. Maybe this, I know you've touched on this, which is the issue regarding the loans provided to the solar farms, and you're unable to confirm whether they are materially impaired or not. I'd be interested to know, or just have an answer from officers as to why officers have decided not to provide this information that was requested by the external auditor. So I'm struggling to understand why that would not be provided.
Yeah, I had quite a long debate with the external auditor on this. I think it comes back to a comment I think I've made at previous audit committees about what feels like time travel sometimes with these sets of accounts. We were, in 1819, we didn't even have the solar farms. We have bought the solar farms since, we have loaned money to them as part of the way we've set them up. In fact, only at the last cabinet we agreed to refinance one of those loans, which would have been an adjusting impact as well. But given that we were at a point where we weren't quite sure exactly when the accounts were being signed off, and that this is something that happened post-balance sheet, and we know that very shortly, and we are evaluating what the level of the loans, and if there is any impairment, which I very much doubt because of the 100% ownership of the way that the council's got the solar farms. But if there is an impairment, we will pick that up and quite rightly include that in the 2023-24 accounts, which we're working on at this moment. I mean, in some ways, the 1819 is so out of date, it's not really that much of any benefit to anybody. And I think, although that does then come back to why it's important to have the post-balance sheet note as well. But I wasn't prepared for us to pay extra costs to go and get a valuation on something that really added no value, as I see it, to the accounts. Probably speeded up finalising the accounts as well, but just for the sake of the limitation of scope.
Okay, but it's a conscious decision not to provide information that the auditor has requested. That's correct, isn't it?
Can I just add, can I just add to Winston now, this came up very late in the audit as well, so we did provide a model that the council had to the auditor that we thought was sufficient, but they didn't think it was sufficient. The piece of work that needs doing, we need to get experts to do it from outside the organisation, because the selling of power is a very complex thing, and it's governed by the second, so there needs to be power curves and everything that needs to go into a model. So as Vincent said, this came up very, very late in the game. If we were to go out, it probably would have took us about 4 or 5 months before we could have got that piece of work completed, which would have delayed the sign-off of these accounts, and also with the backstop date, it would have made it all relatively irrelevant. But we are actually producing that piece of work now. As Vincent says, we're in the process of procuring the company, and we should be able to give you that reassurance when we bring the draft accounts in May.
I thought I'd read in the report that the information is requested in 2019 by the external auditor. I thought that was in this document. I can't put my finger on that page, but
so just to clear. So some of the information that was requested around IFRS 9 was requested in 2019, okay. But that related in terms of the classification of the disabled loans and housing associations and the expected credit losses on those. Obviously, the solar farms hadn't existed at that point, so we hadn't made that request there. I think, I can't remember the exact date, but I think autumn time last year was when we probably started first raising the queries around this impairment review. So whilst they accept probably late in the audit process in relative terms, it probably was about 6-7 months ago.
Can I?
No problem.
I'm speaking with myself here, but as a member of the committee and a resident, I'm not sure how many members of the committee would want to spend residents' money on a valuation for the 2019 accounts for a solar farm that we didn't then own.
On page 6, could you just expand on the comment, which I think is quite, for me, really concerning, that Warrington Borough Council did not have proper arrangements to service economy, efficiency and effectiveness in the use of resources. How wide-ranging was that issue, or did that just relate to the matters identified in 1718?
it relates to the issues that we raised in the previous year, which we felt still existed in 1890. So as I said, that was largely to do with the MRP policy that existed at the time, arrangements to comply with the potential code, and the arrangements to monitor and report investments.
Thank you. On page 11.
Sorry, Ken, just
Sorry?
1 second.
No problem.
Yeah, I guess it's another one of those, it's the timing issue, and Andrew and I discussed this. It does relate to 1718, because of course we didn't have the recommendations for 1718 until 2022, so it was a bit difficult for me and the team in 2022 to make adjustments to our 1819 accounts that we'd already prepared 3 years before.
Page 11. Just like a comment from officers, because there's a reference there, the council is aware that it is not a sustainable way of funding budget gaps, that's the use of reserves, on an ongoing basis. It will need to replenish reserves at an appropriate level, Could officers just comment on what plans we have to replenish reserves to an appropriate level?
This is a matter for what's on the agenda.
It's a matter in the audit findings report.
It's about policy now, not 5 years ago.
It's because within the audit findings report there's the requirement to respond in terms of the going concern type issues and the council. And it is something that quite rightly Thornton have looked at about our overall sustainability, and the fact that both this last year and this year we have balanced the budget by using reserves and then drawing them down. We do have plans that we're working through as officers that will work towards being able to set the legal budget for the council for next year, and beyond that we obviously can't continue to draw down on reserves, so we will need to look at other ways of bridging that budget gap.
I think that's a comment as well you'll find in most AFRs, so if you actually Google authorities, and most authorities are in the same boat, so it's not unique to Warrington.
Okay. On page 13, there's a reference to a 10.2 million adjustment to decrease the value of land and buildings disclosed on the balance sheet. Again, can you just expand on that, please? The external auditor, please expand on that. And again, just confirm that this doesn't affect the general fund. It's a comprehensive income and expenditure statement. It's the third paragraph from the bottom.
Yes, I mean, so first of all, just in terms of the latter comment, this adjustment doesn't impact upon use of the reserves. It gets adjusted out. So this issue was picked up as part of the 1718 audit, but obviously it implied equal to 1819, and this was to do with the assets that hadn't been formally revalued by the council's valuers for that particular year. We have to, because they have to be held at fair value. We did an assessment on those assets that not revalued and assessed that potentially there was a material misstatement by virtue of the fact that they hadn't been revalued in that particular year. We challenged the council and the council's valuer on that issue as part of the 1718 audit, and it was agreed that further revaluation should take place. So that happened, and the impact of that for 1819 was the 10.2 million that's in the report.
Thank you. Just turn to page 16. And the material impairment of Redwood Bank. So is the current value then of Redwood Bank 4.3 million? Is that what our shareholding is worth in Redwood Bank? Because that seems to be different to the figures that have been reported to the Audit and Corporate Governance Committee in the Treasury Monitoring Report. So I just want some clarity. Is the 4.3 the correct figure for the 33% shareholding as it was, or should it be less than that. I think we've been seeing a figure of about 6 million. Thank you.
For the 4.3 was specific to 1819. We've had subsequent valuations for future years that have gone up and down, quite frankly. And I couldn't tell you the exact figure off the top of my head, I can look it up, but the one that will be in the Treasury report will be the current valuation. But that valuation, the 4.3, was specific to that date.
Okay. Thank you for that clarity. On page 17, there's an issue of capitalisation of legal fees. Again, could you just expand on that? I think the adjustment there was some nearly 4.8 million. And does that impact the general fund?
No, so again, this doesn't impact upon general fund because again these get adjusted out. So this, because there's obviously purchased a lot of investment properties, in the course of doing so has obviously incurred legal fees in the purchase of those properties. The council had capitalised those fees, but that we don't believe that that's in line with the code requirements. We believe that they should be expensed as incurred rather than capitalised and then depreciated. So that's what that adjustment it essentially does. It decreases the valuation, but again it does get adjusted out, so it doesn't impact on useful reserves.
So it's acceptable to capitalise legal costs for the general fund?
No. That was we're saying that these were capitalised and shouldn't have been.
Yeah, okay. But I'm just struggling to understand why it doesn't affect the general fund. If costs were capitalised, and then they should not have been they should have been expensed unless there's a dispensation for legal fees.
Sorry, you're right. So the decrease in valuation, the opposite entry does in this case actually would impact on.
It does impact.
Sorry,
yeah.
No.
Actually, it's slightly different tale. You are allowed to capitalise legal fees, but because the valuation that was given by our valuers, they don't include legal fees when they do the valuation. So we capitalise them, they then were excluded as part of the valuation. That valuation was agreed with the auditors. So that's why they have come out of the valuation, but they don't impact the general fund because you are allowed to capitalise them, but you're not. They're not part of the end valuation that we agreed.
So you're allowed to capitalise legal fees for the general fund.
It's common practice when you buy something that you capitalise the full cost shows. So we show that as gross cost, and then in subsequent years we would value. Because we were looking at the specific assets in year, the auditors asked us to revalue those assets. They were revalued without the legal costs. And rather than argue over 4.2 million that's not going to affect the general fund, we agreed with the valuation and moved it on.
Okay, so that might be useful if you just drop an email just to explain how that was treated. So we're clearly saying that the 4.7 million is an adjustment to the comprehensive income and expenditure statement, but we're saying that is not chargeable to the general fund.
That's correct, because they were capitalised, so they went through to the unusable reserves.
Does anybody else have any questions other than Kev?
Got a couple more.
Okay.
Just say a number have been answered, so I'm just working through those that have already been answered. On page 23, there's some IT comments. The ones that concern me are the repeat comments and things like SAPOR. I remember from my time as head of IT in private business, SAP all was something that was really frowned upon. And there's another, I think, separate repeat finding. Might be useful if officers just comment on why there are repeat findings in relation to those concerns.
Can I suggest that we don't have the answers to those in the room today, and that we can come back to the case on that particular question?
Yeah. Sorry, I've given you the wrong reference.
I can't find which page.
It's 23. Page 23. There said 21.
So I can't even see that still now.
There's
It's probably easier if we come back to you with an answer on that one.
okay, I'll just make... I
guess one of the issues that we clearly face is that things that were in the 17-18 and in the 18-19 doesn't mean we haven't corrected them since, but a number of these things is a timing issue as to when the issue actually was in place.
Okay.
I can't even tell you if that's exactly right on this one, because
So, with any sort of IT review, it's always concerning if there are repeat findings. So I presume this was in the previous audit findings report. And I guess the repeat finding relates to this year, but from memory, and it's a long time ago now, SAP all is not a great way to have security within IT systems. Okay, just turning to page 28. Could the external auditor just expand upon the concerns regarding the application of MRP? I think there's a paragraph towards the end of the section which sort of highlights some issues.
So, as members are aware, we obviously did challenge the Council's MRP policy. Obviously that has now been changed. The impacts of those changes have been applied to the final set of 18-19 accounts, so we are content with the charge that's been made in the final set of accounts. There are still aspects of the Council's current MRP policy that we would still challenge on, particularly around the lack of charge and regular banking in the early years. And we would also believe the straight line method would also be a more prudent method for some of the assets that it is charging MRP on. The Council does use a compliant method in terms of the annuity method, and it really is a question for the Council members to deem whether they believe the annuity method is the prudent method to use, but we do accept that it is an allowable method under the statutory guidance.
I think it says that roughly there would have been a 3 million higher charge if the council adopted the your view in terms of MRP.
Yeah, I think the figure is 2.5 million.
Yeah. Okay. Thank you. Yeah. Page 36. Are you able to expand upon your comment that because the council is one of the highest levels of borrowing amongst its peer group, that its usable reserves should be amongst the highest?
So if you benchmark the council's borrowing in terms of its peer group, it does come out in terms of the quartile. As a result of that, we do think reserves should reflect that as well. So when you're comparing your reserves against peer authorities, you should be in a similar position in terms of reserve levels and in terms of usable reserves. So comparing yourself, for example, to say the average of your peer group probably isn't appropriate, because not all authorities have the level of borrowing and risk that this council faces.
Okay, thank you. Would you be able to provide an indication of the level of usable reserves that would appear to be appropriate?
That's probably not a question for me to answer. As your auditor, it's very much a view that you need to get from your officers rather than from me.
Thank you. Page 41, follow up on the prior year recommendations. What's the significance of the red dots?
Sorry, which page?
I think it's page 41 onwards. So there are those with ticks against crosses, but there's also those with red dots. I wasn't on page 44. The red dots start, I think. Assessment is a red dot on the far left-hand side. I wasn't sure.
Classified at the bottom of the page.
Sorry, continue.
Yeah. Oh, sorry.
So the red dots just that's actually the initial risk assessment that we applied when we raised the recommendation. So there is a little key at the bottom that just which kind of sets out what it means in terms of basically red does mean high risk. Medium would be amber, and green would essentially be kind of low risk best practice points. So the red dots essentially mean that we rated these as high risk issues.
Okay, thank you. There are a number of items that have not been addressed from the prior year recommendations. Can officers explain why some of the actions remain outstanding?
Which page are you referring to, Councillor?
Starts on page 41, follow up the prior year recommendations, continues on page 42. Also 41, 42, and I think also on 43. There are ticks and crosses against each one, and a number, like the members register, page 41, members register of interest has a cross against, and I'm assuming that means it hasn't been addressed.
I think that one was one that Thornton identified that some members still weren't filling in the register correctly. If we've got particular questions on particular ones, we can hopefully answer them. I'll just try and run through the whole list.
Well, there's a number that haven't been addressed. Members register of interests.
I can see two. I know it's a number.
I think most of them get picked up in our updates to the annual governance statement. But there might be some. And that's how we've cross-referenced to update the annual governance statement as well.
Let's just clarify then, are we talking here about issues that haven't been addressed because they arise from 17-18 accounts? All we're going to get is that each subsequent set of accounts, you have exactly the same issues raised with our management action up until the point at which those issues were raised by the external auditors, am I correct?
Or just another way, Chair, we are looking at things that were raised in 2019 that haven't been addressed from 2018 accounts. We're 5 years on from that, and it really is a bit pointless trying to guess whether they're there.
Yeah, I think think I see where they're coming from. If you take the one on the use of unaudited figures and you look at what was used for Redwood Bank, of course in 1718 and 1819 we then looked at the same issue because the recommendation wasn't actually given to us until June 2022. So we couldn't have made, we didn't know to do something different in 1819 because we hadn't been told that we'd done it wrong in 1718 at that point. And that will continue to be an issue for all subsequent years until we get back up to date.
Okay, that's helpful. But members' register of interests, why would that not have been addressed?
Just one second, Matthew.
Yeah, I was going to address that, Chair. It's because officers can't have no control over members' register of interest. It's down to members to fill them in. There's their legal liability. Even if we came across an error, we couldn't amend the form because that would affect the provisions of the Localism Act. So actually, that's a matter for members. It's not a matter for officers. We provide our updates our reminders as we should do. It's a matter for members to keep them up to date.
Then shouldn't that have been the response to the matter raised?
My recollection at the time is that it was.
I'll come back to these. Even if we're just dealing with what's in front of us, there's 8 prior year recommendations, 6 of which have been completed, and this thing with members' declaration of interests is probably has been never, but couldn't be then.
No, it's helpful to have the comments from officers, but with any list of actions, it's the ones that haven't been addressed that should receive the focus. So just turning to page 47, monitoring and reporting of non-treasury investment. This relates, I think, there's a reference to the PwC report. When was that PwC report completed and issued? Because I think that was before my time at the Audit and Corporate Governance Committee.
It was issued in 2020, might be 2021. I'm struggling with the dates as to when that was actually issued by PwC. Obviously we had an action plan from that, and that action plan has subsequently been overtaken by other reviews and ongoing reviews. But
Okay, there's a very clear recommendation there, so which says management is still working on carrying out the action plan that came from PwC governance review. Once this is complete, we recommend the Council Commission follow-up review, which I think is in the actions. But I guess my concern is why the PwC report that came out in 2020, why all the actions in that are not complete.
the majority are complete, but there are some that will never be complete because it's ongoing work to improve the way that our governance works around our investments.
Page 48. There's a recommendation in relation to, we still believe the Council could be more proactive in bringing potential audit and financial reporting issues to our attention, especially those relating to new investments or changes to existing investments. You know, my question is, why does the auditor feel that they're not being fully briefed on these investments?
Probably ought to be a question back with the auditor. From my perspective, we do fully engage with the auditor in advance of any of these things. We've involved them in risk workshops. I think one of the issues that's probably linked to this is the Council hasn't done anything along these lines for a couple of years because we've moved away from some of our more commercial activity. But all of the things that we regularly refer to, whether it's Redwood Bank, Redwood Bank or Birchwood Park, you know, we had involvement with Grant Thornton at a very early stage on that to discuss everything around it, including the risks and the accounting arrangements. We have actually, there's one just thinking of that we did engage with Grant Thornton, and you recollect this, is around LifeWire, bringing it back in-house, making sure that the auditor was completely aware of the risks and the work that the council was doing on that. But that's probably the only one that I can think of that is relatively recent in terms of needing to have engaged in.
So, in terms of the many of the transactions that have taken place, we have been, Linton has been aware of that. I think what this comment is trying to get at, and probably could have been a bit clearer about, is actually being more proactive in terms of the preparation around financial reporting requirements, in terms of how that impacts on the account. So bringing those issues to us at an early stage in terms of management's view on those issues. So I'll probably use the example of IFRS 9 in terms of the impacts of that. Well before the draft accounts were prepared for 1819, ideally what would happen is a full IFRS 9 assessment is prepared with all the expected credit loss assessments at that time. So that could have been something that was happening in 2018, 2019, as opposed to something that was happening more recently. We got the expected credit loss assessments in a way that we felt was acceptable only in February of this year. So that's really kind of what the comment was getting at there. So just to be clear, it's not that Linton hasn't been making aware about certain transactions taking place. It's more about the early work on the financial reporting requirements and impacts on the accounts.
Yeah, thank you for clarifying.
I'd just like to make a comment about the IFRS 9. Because we originally did the IFRS 9, I did the assessment. We then got an external person to look at that assessment. They agreed with my assessments. Subsequently, the auditors have asked us to do extra work, which we did. We commissioned EY. EY disagreed on 3 instruments, which we disagreed with EY's assessment, and then the auditors themselves agreed with our disagreement. So we've spent a lot of money and we've come back to the original point, which we actually paid money for in 1819. So just wanted to make that point.
Okay, finally on the AFR, page 61. Long-term loans arrangement fees. I think I misunderstood this when I first read it. These arrangement fees that were paid to the council and then immediately taken to revenue, have I understood that correctly or not? Page 61 or page 59, and it's the long-term loan arrangement fees. And then, again, the question, this obviously impacts the CIES, but does this also impact the general fund?
This one would, yes. That's right.
Yeah. So income was recognised ahead of what prudent accounting would say should be the recognition of that income.
Yes, that's correct, yeah.
Okay. Just a question for officers then, are we sure that that is not continuing to happen?
Yes.
Thank you.
Does any other committee member have any questions?
Yeah, thank you, Chair. Just looking and focusing on fees, page 62 in the pack, 60 in the report. Obviously, there's a massive difference between the initial proposed fee based on the scale fee compared to the final fee. And I was just wondering if you could give a breakdown of that. Sorry, Andrew, this is a breakdown of that in terms of additional work and what the source of that additional work was and how much it was due to addressing the objection.
So the breakdown's on the following page. Most of the increases actually relates to accounts related work. I don't know if we've actually broken down separated out the objection, but it was actually that was largely incorporated into the audit work because most of the work actually related to the accounts audit. So I don't think there is a separate one of the objection, but it's kind of in the accounts audit breakdown.
Sorry, I misunderstood your reply initially. I thought you meant that particular part was included in that breakdown. In which case, can I ask the officers what their estimate of the additional work specifically relating to the objection would have cost the council in fees paid to the external audit?
Yeah, I think, Andrew, we actually discussed this at a previous meeting as well, because I think you brought the increased fee around that. My understanding was just over £50,000 purely in relation to the work on the objection. I suppose there are some parts of this other breakdown that kind of link back to it because of things being delayed on the 17-18 accounts that meant extra work has had to be done at a later date, but it's probably not easy to try and split it out, and I wouldn't have thought that even Andrew can split that part out.
So, sorry, just to be clear so we're not getting confused, so obviously there was the 17-18 objection, that was obviously reported in the previous year's NFR, I think that was about 50,000-60,000 as Linton said. The objection that didn't become an objection for 18-19, as I said, we've not given a specific breakdown for that because we've not treated it as a formal objection and we've just incorporated it into kind of where it's impacted. It's largely kind of focused in the work that's been done around the valuation of Redwood Bank, which is actually the line that it's £26,000 and talks about additional procedures in relation to subsequent events, including assessment of impairments in Redwood Bank together MG, and also the additional procedures above that in relation to Redwood Bank investment. So it's those two lines essentially that the additional work's incorporated. But just to be clear, we'd have had to do that additional work anyway, regardless of whether the objector had written to me or not, because it relates to the accounts audit, and we would have asked those questions in any case.
Okay, I think we'll probably have a different opinion on that. I mean, I think it's fairly clear in terms of the additional objection against 17-18 accounts. My reading of the response from the officers and looking at this is that actually the overall impact of that objection led to additional fees for application of changing standards, different approaches, etc. And that's the kind of cumulative impact I'm trying to understand, because ultimately, even though the objection was no longer valid and you did that additional work, there was only one aspect of that objection which you considered to be valid or to uphold. So what I'm trying to get to is whether somebody can tell me what the cumulative impact in financial terms on the council was through increased audit fees due to those objections raised. Maybe that's a bit of a difficult sum to do.
I was going to say, I'm not sure I could easily do that. We wouldn't, I'm not sure I'd be able to analyse it in that. What I would say is for 17-18 and 18-19, the additional fees that we have raised for both those years, a significant proportion of that additional fee relates to the fact that there's been some significant changes in relation to our auditing standards, which meant that we've had to do a lot more work around valuations of land and buildings, for example. And obviously a lot of the post-balance sheet events stuff, obviously that is a direct consequence. So all I can say is I can't give you a figure, but I can just say that a vast majority of the additional fee increases that we've seen in this year and the last year would be on a direct consequence of the objection that was raised in 17-18.
Okay, thank you.
Yeah, I think I'd concur with that, Andrew. I mean, I guess the issue is there are things that you've had to do more of, like post-balance sheet events. If we had been in the position of signing off 17-18 at the original time, we should have signed it off, and then consequently the same on 18-19. We wouldn't, between us, have all of this extra work on post-balance sheet events. we wouldn't have had the impact of the McLeod judgment quite as early. There's a little bit of work around that. There's probably other bits in there that wouldn't have happened when they've happened. I think last year, the delays on the infrastructure assets issue, that wouldn't have impacted. We probably would have had 3 or 4 years of accounts signed off before that then had impacted on the much more recent years. So not easy to try and split it out, but clearly significant impact.
Okay, is any more comments? Right. Can we turn to the annual governance statement, please?
I hope to be quite brief about the annual governance statement. So, the 18-19 original annual governance statement was approved by the Audit Committee at their meeting in July 2019. And for members who were around for the 17-18 accounts review, the approach we took in agreement with the external auditor was to provide an additional appendix to the original document which had already been approved, so there was no change to what had been reviewed. We've taken the same approach for 18-19. So Appendix 1 of the report is that additional appendix, and then Appendix 2 of the report is the original 18-19 unchanged approved document. The only thing I would say is I apologise for clumsy wording in 3.2, which is a slight contradiction on what I just said, because it says it's been updated for the governance year in the intervening period, which is not absolutely accurate. So what we'll do for 23-24, it'll be a reflection as at today for 18-19. What's included in the appendix is everything referenced by the AFR in terms of some of the discussion already had and some of the points already made in the preceding discussion. I'll leave it there.
Thank you for that. Any comments? Ken?
Okay, I think I struggled last time. I'm struggling then. Who's going to sign this annual governance statement, and when are they going to date it?
I'm not clear on that. I would defer to Matt. It's usually Chief Executive Leader, Monitoring Officer and AN Other, and at the date the accounts are signed. If there's any corrections there, I'll defer to colleagues.
Yes, I think we've got, Chair, sorry, if we could have signed at the time, and then if there's any updates, then I would see it can only be signed by the people who are responsible at the time for the addendum which has been added. Otherwise it would make obviously a difficult situation when we've got changing personnel since then in terms of the people who are signing, so that's how I see it.
And when is it going to be dated?
Well, if it's being signed off today and it's been dated, then it's dated today. I can't see how I can date it on the basis of information which I didn't have at the time in 2018.
Okay. And how can the statement not refer to adverse value for money findings? So you've got a statement that says that we haven't had it. I'm really struggling with someone, I'm glad I'm not signing this, with someone signing this document, dating it in 2024, but the document not referring to 2 adverse value for money findings of this council by the external auditor. I mean, there's no other issues within the document, but now I sort of understand how these 2 documents sit together. I've got a real, I was head of legal, but I was never a legal person. I've got a real problem with someone signing and dating this and it not being at least reflecting the fact there have been 2 adverse value for money signings. The wording in this refers to no reports have been produced out of it. To me, it just is. It's not the way I would expect something to be handled.
I'm happy to respond to that. I think the approach we've taken is in line with the approach we took for 17-18, and I think because the adverse VFM judgments are in the AFRs for those years, the actual information in the annual governance statement is lifted from those judgments. So I take the point that actually the judgment should be referenced in the header at the top of the appendix. I think that's an amendment that I would accept that we should be making. but the actual content is lifted from those judgments.
Okay, I mean, you've agreed the approach of the auditor. I mean, I just think it's wrong. I think it should be brought up to date with the knowledge we have when the person who signs and dates it. Because the signing and dating a document that says there is no, we don't know the outcome of the audit, and we do not have an annual audit findings report. I would refuse to sign, just at a personal level, I would refuse to sign this document as written, and I am surprised that others are willing to sign it. Okay, a couple of comments on Appendix 1. Major investments. I think this was touched on in the audit findings report. I think it would be better if this were led by the monitoring officer. I think that would give the head of internal audit a different reporting line, and I think this is something that correctly sits with the monitoring officer, compliance with the council's constitution. So I can't accept. I'm just feeling about I'm concerned that the structure isn't that the monitoring officer is taking the lead in that in relation to that.
Sorry, Chair, I hope I'm sort of not trying to misbrand it. It's, I appreciate that my post has been mentioned, but it's an operational matter for the council. I don't have any remit to do anything about that, I'm afraid. But so if you're doing my not answering, it's because there's very little I can do about that, I'm afraid. It's an operational matter for the council.
Okay, I'll just make a recommendation then that it is the monitoring officer who is the lead officer in relation to the review of major investments.
Council, what do you call it? I didn't call you anything else to say.
I thought you could be Councillor Bull.
No.
I wanted to pop you on the nose. This question for officers, 270 of the pack refers to the Commission in SIP to do an independent review of the Council's capital plan, borrowing, governance, etc. So what we're told here is in the table is the work began in Q1 2023. Could you summarise where we're up to? And given that we had a draft report, the council had a draft report last summer, what on earth is happening?
Yeah, as it indicates in the report, the bulk of the work by SIPFIL was completed during last March. I actually got a note in my diary the day they gave us the feedback from their review towards the end of March. We received the first draft report in July for us to be able to comment on factual inaccuracies. There weren't that many. It was actually a fairly substantial report at that point. And we were then issued a draft report in September 23, which we were told we were not allowed to issue wider. It wasn't our report, it is a DLUC report commissioned, but it was a SIPFA report commissioned by DLUC, so we needed to wait for DLUC to issue that report. We're still waiting for DLUC to issue that report. I have chased up the Assistant Director at DLUC a couple of times. We have got a draft action plan linked to the recommendations from it. But it's very difficult to share the action plan when we're not allowed to share the report, because it then indicates what's in the report as well. But as officers, we're already working on a number of those areas. So on the point, if and when that report is ever published, we've got an action plan that we can properly engage with. My concern is that we're now a year after the work was done, and the longer it goes on, the less relevant the report actually becomes to where we currently are.
That timeline you just expressed there seems incomprehensible. That the technical work was done by SIPFA in a matter of a few months. A report was written, provided for the council, commented upon, and yet we're now 8 months on from receiving that draft report. What could possibly be going on, do you think, in relation to SIPFA and DLUG? And can you think of any reason why DLUG would choose not to publish that report?
I can't think of any reason why they choose not to issue it. One of the issues, and you only have to look in the press, I think DLUG probably themselves are overstretched in terms of the number of other councils that they're having to intervene in, councils that are receiving exceptional financial support or councils that are issuing Section 114 notices. There's a growing list there, and DLUG are having to try and support all of those councils. I would have hoped if there was anything that was on our report that DLUG themselves thought was really dramatic and that needed immediate action, that they would want to have issued that report immediately. There are a number of things that we can improve, clearly, from the report, but there isn't anything that is absolutely that's catastrophic and the council has to do it immediately. But I can't say that because I can't share the report.
Understood. But, what we've been having, and of course this afternoon, is discussion about various comments by members which are about the performance of the council. And here we've got a situation which is well known in media and well known locally. And the delays by DLUG are potentially harming the reputation of this council. And given that the accompanying letter by the Minister was leaked to the press and was using rather colourful and sensational language, that only adds to the potential risk to the council. I thought everybody on this committee would want to press DLUG to have that report, so they had some confidence in the government's arrangements to this council and obviously its capital programme. It just simply beggars belief.
Can I just say, I totally agree with Russell. It's beyond, well, it's beyond me why we haven't had this report published. The thing that gets me is that I'm sure there are some sensible things in the SIPFA report that we would want to do and we have to do it. But it's written sort of hinting the delay actually stops us putting into effect some of the things that the government wants us to do. And to me, it's an utter nonsense. And I hope there's no political influence on this delay. I'm sure there won't be, but it is just possible that there's an explanation which would be totally wrong. Given all the sort of games that effectively being played on this. And I just find it incomprehensible why they can't even tell us and why there should be such delays. As Russ says, people are complaining about the delays in this council, and here we have some delays by government that can't get their act together. And I find it just, well, it is comprehensible because we think we know why it's happening. But on the face of it, it is incomprehensible why we're having these delays. And any pressure we can put on to expedite this, the better.
I think we'd all agree with that, Ian. Ken?
I'm not sure that the delay in the report would stop the council taking actions if they're in the best interest of the council. So I don't accept the fact we haven't got the DLUG report, that the council can't do anything to address whatever issues were identified in that report.
Ken, the DLUG report is referred to quite a few times in this document before us today, and it would suggest that they are also waiting for the report before they can comment on what further actions we can take. So it's clearly of an important for the, for both for this meeting and for the council itself. Right, Linton.
Just to try and give members some confidence, yes, we've seen the draft and provided those recommendations on the version we saw in September don't change when the report is finally produced. We have as officers, produced a full action plan on all of the recommendations. A number of them have actually been implemented already, but I won't tell you what they are, but we have implemented some of them in things that we've changed since, and we are implementing others and we're working on them. We don't need to tell you that they're part of those recommendations, but they're things that we are changing and improving. And then when the final things come out, we will hopefully then be able to publish that alongside it with our draft action plan and show the differences we've made. We have actually shared that draft action plan with DLUC as well, so it's not as if they don't know what it is that we're working on, we just can't publish it.
Sorry, there's a question for the external auditor. Have you seen the report? No. Because I mean, even that, if there were significant issues in there, they should be, you'd expect them to be brought to the attention of an external auditor to support the work that they're doing. Okay, thank you.
So, just getting to right. So essentially, you've taken action based on a draft report that you're under instructions not to share publicly, and if you tell people the actions you've taken, that would offend the instruction to keep it confidential. You're not second guessing that. Can you just say these are the actions we've taken based on a draft report which you cannot see?
Yeah, we've touched up on the last, I think. The Constitution is clear on what confidential information is. And I'll read it to you because my batch is on 0%, so we're only doing that. Confidential information is information given to the council by a government department on terms which should forbid its supply or disclosure to the public. So the trick is, how do you run the recommendations without releasing the confidential information? As Linton said, it may be we're already doing it, or we can't tell you why we're doing it. So it's a difficult balance. Some of it we may not be able to do without overtly saying, yeah, this is what the SIP report says. Thank you very much. So that's the balance we've got really.
That's what punishment is for getting it wrong.
Well done.
Right, are there any other comments on this?
And the additional items, improvement action per audit findings report 2018-19, page 69. And as it continues on the page 70, the APAM report is referenced, but I am not clear that that was the original purpose of the APAM report. And we're also in a position where APAM, I understand, have refused to continue with their report until DLUC have completed, till we have the detail from DLUC. And I question whether APAM are the correct people. We want, according to this, we want a report. I would question whether we shouldn't be going to someone more committed to producing a report rather than waiting for DLUC, for the DLUC report. So again, I am uncomfortable that APAM are being used in this circumstance, and that report has been referenced in this document. There's also reference to additional resources. Will those additional resources include IFRS 9 expertise, given the issue that the council has in relation to the provision of data in relation to the solar farm? So there's one question on APAM and one in relation to the additional expertise that is coming.
Yeah, on the APAM issue, I think those members that have been on committee a little while will remember that we even struggled to get any firm after having advertised and tendered the opportunity. We just struggled to get anybody. It took, I think, 3 attempts for us to get APAM to do it off of one of the government frameworks. APAM more than qualified to do the piece of work. However, even then, when they realised there was a DLUC review going on, they pointed out they didn't want to duplicate any of the work, but DLUC wouldn't allow us to share the report with APAM. So it just seemed we'd be paying APAM to potentially do something that they didn't think they should do until they see what the outcome of the DLUC report is themselves. So I actually had a message from APAM yesterday asking me to update was the DLUC review about to be issued, because they would just quite like to finish the work, because they aren't that far off of having completed it. They got to that point nearly last July. On the IFRS 9, well, I think, as we said earlier, one of the anomalies is that actually we have got people that are qualified and able to do it, and the work was done. We went round in full circles before we ended up with the work that Mark had initially done being agreed that that was the right way forward. We do need extra support from the team, and part of that we will need to discuss with our new external auditors, with Mazars, to understand how exactly we can work alongside them to ensure that we don't slip behind and end up with delays in future years for accounts. But I think that's a discussion that I'm arranging with Mazars as soon as possible.
We did ask to speak to APAM before they finalised any report to raise our observations regarding the subsidiary companies. At the time that didn't happen. Again, I just question whether APAM are right, given that they haven't proceeded and produced the report that was requested by this committee.
No, is any other comments? No? Well, this one says that, sorry, you have to review and approve the updated annual governance statement. So I put it to the committee to approve the statement. All those in favour? All those against?
And could I ask that my name's noted? Thank you.
Right, we move on to the statement of accounts. Is that the answer?
Yeah, and if there are any questions, I'll probably the platform hand over to the team. I firstly want to echo something that Andy said earlier in terms of thanking the team for all of the work that has been put into this. I probably said the same thing back in July 2019, because putting together a set of accounts, of local authority accounts, is actually a big piece of work and requires a lot of effort from the team to meet the deadlines. In fact, we've never missed a deadline for issuing our draft accounts. But what we have got here is a set of accounts that were first issued as a draft in 1819, have now been audited to death by the external auditor, and we've made all of the changes that we've been asked to. I think there's one thing, we've circulated a piece of paper to all of you this afternoon. There's just the other minor changes that we've made since this pack was issued, just that we've been agreeing during the last week with Grant Thornton, just to make sure that the final version, when we sign it off, we are completely in agreement over all of the accounting treatment within the statement of accounts. I'm not going to take you through it page by page. I think we're all used to what our accounts look like now, and you've probably fed up with this set of accounts as well. So, but between us, happy to take any questions, but I can give you assurance that these have now been audited by Grant Thornton are a true set of accounts.
Okay, thank you. Any comments? No? Ken? Yeah, I've seen it.
Only a couple of comments, should be delighted to know. Page 143. There's a reference to the accounts were completed within the timescale, but there was an adjustment to these accounts. The C comprehensive income and expenditure statement now shows and just correct me if I'm wrong, please, Andrew, almost 100 million deficit in the year 18-19. Previously, that would have shown a deficit of about 10 to 15 million. So for me, that's a pretty material adjustment to the comprehensive income and expenditure statement. I don't know if the external auditor would like to comment on that.
Yes, that's correct. Sorry, yeah, I think you're...
Sorry.
Yeah, that is correct. But as I said before, a lot of the adjustments that have been made to that position don't impact on usable reserves, so they do get adjusted out through in other ways through the movement on reserve statement.
I think it would be good to have absolute clarity on which, I think there's one, but there may be more, which of those adjustments have affected the general fund, because presumably those adjustments flow through to usable reserves if they impact the general fund.
Yes, I wouldn't be able to supply that now, but I'm sure we could provide that information up front.
Thank you. And on page 144, I'll just point out that borrowings on 31st of March 2019, long-term borrowings were just 827 million. Okay, so that's probably worth noting. And I have one comment in relation to page 226, which is the reference to the Altana Wealth. I think that correctly should be referred to as the Altana Bond Fund. In that, so that rather than Altana Wealth, which is not specific at all, that will refer to as the Altana, the full details of the Altana Bond Fund. And again, we'll just raise, we have a concern that investment was not constitutional. So when there is a review by the internal auditor of decisions taken and whether they respected the Constitution, I'll just flag again, we have a concern in the Conservative group that investment was not constitutional. But that should be correctly identified if that is the case, if it is the Altana Bond Fund. Thank you.
Any other questions, comments on the accounts? Steve?
Sorry.
That's whether that's a political comment about the view of the Conservative group.
I will then make it a view of a member of this committee that investment was potentially unconstitutional.
Right, can we move on to the letter of representation, please? I thought we were taking everything at the end, the other three, but if you want to... Yeah. Okay, yeah. Can we move on to the letter of representation then, please?
So it's a little while, so almost Adam and I were talking about this the other day in terms of the order of items that the company wanted to sign off the accounts. I think Andrew and I had almost forgotten that we didn't have the letter of rep on its way to you either until late on in the process. But this letter is, in effect, comes from yourself and from me, Chair, and provided the committee are happy with it, to write back to the external auditors to give that assurance that what we've presented in the accounts is in a true and fair view and in line with the code of practice. If anyone's got any questions on the letter, but it's a very standard form of wording and saying that we've done everything that we're supposed to in terms of statute and that we've highlighted anything to the auditor that we thought we needed to bring to their attention and we haven't given anything away. Alongside that, giving them access to everything that we have done. I don't think Andrew would provide us with the standard form of the letter if he didn't think we'd give him access to everything he needed to have access to. So hopefully it's a formality in terms of the committee agreeing for us to sign that letter. So.
Ken?
Okay, a couple of, I think someone's still on. Yeah, a couple of comments and observations. Should the letter not refer to the fact the information has not been provided as requested on the solar farms? Should that not be an amendment to this representation letter? I'm familiar with standard form representation letters, but it's quite unusual when it's specifically noted that information has not been provided. I would imagine that should be incorporated into this letter. If we go on, and then if you want to come back. Again, I've got an issue with who's going to sign and date this, because there's a reference to the annual governance statement, and as I've said earlier, I don't believe the annual governance statement correctly reflects the information that we now have in relation to things like the adverse value for money finding. So I am struggling with this in two respects. One, that it doesn't reference the decision not to provide information on the loans to the solar farms, and that it references an annual governance statement that I do not believe accurately reflects the knowledge that we have today. Thank you.
The annual governance statement's just been passed by the committee.
And I voted against it.
But it's still just been passed by the committee. Andrew?
Yeah, sorry, just in relation to the point about the lack of representation around the information on solar farms, what we've, I mean, the reason I wouldn't have an objection to management adding the statement to that effect in here. We actually felt it was more important that there was some form of disclosure in the accounts, which I appreciate you can't see it, but it is one of what's noted here, that there is a statement in the disclosure note to say that management have chosen not to provide the permanent review of the solar farms to us in the accounts itself. In terms of the representation here, I'm kind of relaxed either way, so I'm happy for it to be in there, but equally happy for it not to be, on the basis that we know that management have chosen not to provide it and have disclosed that in the accounts.
Yeah, okay, my view would be it will be lost in the accounts, and it should be, that's my view, it should be disclosed in the representation letter, which is a much shorter document, and time spans may allow people just to pick that up. Thank you.
The representation letter is obviously a letter to us. It does form part of our audit evidence. So I suppose getting evidence that management are not providing something to us, I'm quite relaxed about it.
Okay, I'll leave it at that.
I would say, Chair. Want to do the recommendation?
Yes.
Chair, can we run through the recommendations?
I'm just going to do just that, Ken. Right. Recommendations. That the committee note the contents of the audit findings report from Grant Thornton on the audit of the financial statements. Note that the Director of Corporate Services will submit a letter of representation to Grant Thornton and approve the audited 2018-19 statement of accounts. That's put to the committee. Do we have a seconder? Okay. All those in favour of that path of action? All those against?
Thank you. No, so voted against, please. That's in relation to annual governance statement and auditor's letter.
And with that, I think the meeting's concluded. Thank you very much.